everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, June 1st, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we see futures are a little bit mixed. We had a little bit of selling on yesterday. We're going to go over that in just a couple minutes. But right now, I'm showing futures down 11 on the Dow. Up 6 1/4 on the S&P 500 and up 10 1/4 on the NASDAQ. Crude oil prices down another 20 cents, just below $68 a barrel. And the 10-year Treasury yield relatively flat, maybe up 1 basis point, 3.64%. Starting a new month of June, historically, the third month of each quarter, third calendar month of each calendar quarter, tends to be the weakest. So if you look at March, you look at June, you look at September, you look at December, those tend to be the weakest months. So that's one thing to consider. But we are still in a period where growth tends to outperform value. Aggressive tends to outperform defensive because of that. And we have certain periods of the month of June that tend to be very strong, and we happen to be in one right now. From usually from Memorial Day through about the first week of June, the market tends to move higher. No guarantee, it doesn't happen every year, but the tendency is for prices to move higher based on history on the S&P 500 since 1950. So we'll see whether any of that plays in. This is the first day of the month, and typically you see money flows coming in. This is the first day of the month, historically, is the best day of the month. And I think a lot of it has to do with either money flows or the anticipation of money flows. Maybe the money flows come in on second or third, but you've got Wall Street knowing that that money's coming in and shares get bid up. So that's the tendency. Let's see what happens today. Right now, like I said, futures are mixed, not really showing a whole lot one way or the other. And we did see some selling yesterday. So let's go through the agenda real quick. We're going to start off with the daily market recap, and then jump into talking technically, chart of the day, gold and silver. Give you a little thoughts on both of those. I'm not huge fans. I'll tell you why. And then earnings spotlight. We'll wrap up with the three you must see. Be taking a look at 3 Dow stocks, 3 stocks that didn't fare so well yesterday. See if they've got more technical issues ahead or maybe getting close to a buy point. Anyhow, we'll do that at the end of the show. So make sure you stick around and tune in for that. But for now, let's go through and let's talk a little bit about what happened yesterday in the daily market recap. So Dow Jones yesterday finished down 134.5 points. That was down 0.4%. S&P 500 down 25. That was about 0.6%. NASDAQ dropped 82 points, which was also down about 0.6%. Mid caps down 1.4% and small caps down 1.3%. So mid and small caps again took the brunt of the selling. Part of the problem with the mid caps, and especially small caps, is the makeup of small caps. I was pointing this out to members yesterday in my daily market report to our membership. But small caps are not made up of the same groups as, say, the NASDAQ or even the S&P 500. So whereas the NASDAQ, 80% of the NASDAQ 100 is comprised is composed of technology, consumer discretionary, or communication services. 80% of the NASDAQ 100 or 80% of the QQQ, those 3 key sectors, which have been on fire in 2023. Small caps, on the other hand, you've got healthcare and you've got industrials and you've got financials leading. The 3 aggressive groups that I just spoke about, those are all technology, the consumer discretionary, and communication services. Those 3 sectors only total 25% of the Russell 2000, which is another small cap index. 25% versus 80%. So if you want to know why the NASDAQ is going up this year, and you can see the small caps, mid caps been going down this year, the big difference are those 3 sectors. and their representation in the various indices. So there's nothing wrong with small caps. I mean, well, there is something wrong with small caps. As I said, they're invested in areas that are not participating. But if we were to go back into the last quarter of last year, small caps did much better. Why? Because industrials did well. Financials did well. Those two groups in particular helped small cap outperform the NASDAQ in the fourth quarter. I mean, you can see in December, pretty much straight shot down. Of course, December wasn't very good for small caps either. But October and November, coming off that October low, industrials and financials were really leading at that point, and that's where we saw some strength in the small caps relative to the NASDAQ and the fact that so many technology stocks reside there. Anyhow, moving on. So we got utilities, healthcare, real estate, staples. Those are your four defensive groups. Those were the four best performing groups yesterday, the only four in positive territory. Utilities got a nice bounce, up 0.9%. Healthcare, almost 0.9%. Real estate up 0.6%. Staples up about 0.1%, which was still better than the alternative of dropping, which is what the other 7 sectors did, led by energy. Crude oil prices have been dropping like a rock, and so have energy shares. Just 6-7 weeks ago, the XLE was up at 87.5. Yesterday, 76.5, $11 down. And this is in a market since mid-April where the S&P's gone up, NASDAQ's been scorching higher. Really doesn't make a whole lot of sense when you think about it on the surface. Think when the market goes up, everything goes up. It's not always the case. We have rotation. Right now, that rotation clearly is toward the more aggressive areas. Moving on to the 10-year Treasury yield. First, let's go over some of the economic news that will be out later today. We've got the May ADP employment report, expecting 160,000 jobs there. April was 296,000, so we are expecting a slowdown. Initial jobless claims last week unexpectedly dropped back to 229,000. It had been rising, got up, I think, to over 260,000. Last week, 229,000. This week, we're expecting a jump back up to 235,000. We'll see. Q1 productivity, initial reading for Q1 was minus 2.7%. That came out last month. The current expectation, same, minus 2.7%. Same with Q1 unit labor costs. These are the annual numbers. But last month, the initial reading was 6.3%. That's what we're expecting again this month. The May ISM Manufacturing Index, slight drop. We're expecting a slight drop. April was 47.1. For May, we're expecting 47.0. And then finally, looking back in the rearview mirror, April construction spending looking to rise 0.2%. March rose 0.3%. So a little drop in April. But again, today's first day of June, so we're really looking in the rearview mirror at some of these housing reports. Looking at the 10-year Treasury yield, though, very quickly, just gapping back down the mornings and not really doing a whole lot of rallying, a little bit of intraday rallying, but by the close, we're closing down near the lows. Like I mentioned earlier, we are just a little bit above 3.64%. Let me get the latest, see if that's changed at all. Nope, still the same, 3.643. So up about 0.6 basis point, so back up to still 3.64% rounded. So not a whole lot there, but a lot of economic reports going to be coming out later today. We're going to have a lot more Fed speak. We got the Fed meeting coming up in a couple weeks, where the majority of folks now expecting the Fed to pause and do nothing. But it'll be interesting to see what they have to say. A lot of times it's not whether they raise or lower, because if it's built in, it's built in. It's really if there's any new wording, anything new that they've added to their outlook. That's what traders will be focused on. All right, let's keep moving here. Got a lot still to go over. So let's talk about the S&P and the NASDAQ, talking technically. Got the S&P 500. Had that big breakout on the open yesterday, or continuation. We've pulled back for the last 2 days. So we saw Tuesday, the big gap up after the debt deal was struck between Biden and McCarthy. But we've been selling off since. I wouldn't say a big sell-off, but selling off nonetheless. And I think a lot of that has to do still with the uncertainty. I don't think it's an uncertainty, but that's what the media will lead you to believe. We run into these issues with the debt ceiling. We've run into it many, many times. And every single time it's been resolved because the alternative is unacceptable. It's going to be resolved again. So to me, it's just a lot of talk about nothing. But anyway, we are seeing some selling here the last couple of days. Watch that 20-day. I mean, we did break out above the 41.79 level on the S&P back here, middle of May. 3 days, we closed above 41.79, then we pulled back. We did go just slightly below the 20-day, but only lasted 1 day. And then we're right back up above it. We're trending above it. So that's the first key line of support I see for the S&P 500, the 20-day EMA, which is at 41.54. So you got 25 points, which is about 0.6%. That's what we have to the downside. Below that, then you've got the recent low down close to 4,100, along with that 50-day EMA, which is at 41.10 and rising. So not a whole lot of room here down to these first two, what I would say are key support areas. NASDAQ 100. Black candle at the top. I wouldn't exactly say that's well, I mean, maybe you can call it an island reversal. We did have an uptrend. We gapped up, and then we gapped down yesterday and left that one candle up on an island. So a lot of times you'll see a top form like that. I mean, we saw it here. Over here, we had a black candle off this uptrend. Here, black candle off this uptrend. So you had a black candle and a potential island. So I think the bulls now have their work cut out for them to get back through 14.5 here in the near term. Longer term, I don't think it's going to be an issue, but short term, it could. I look at the rising 20-day anytime I'm in an uptrend. I always look to the rising 20-day moving average as support. And for the most part, since the beginning of the year, we had this time late February, early March, a little bit of weakness below the moving averages. But other than that, really only 1 or 2 days right there. And we've been trading above the 20, which has been above the 50. So this is a very bullish configuration. The daily PPO remains above the center line, telling us that the bulls continue to have control of the momentum. So no doubt the NASDAQ, the picture on the NASDAQ looks the best. I believe we're going to eventually see rotation and all the groups will come up, all the different sectors, all the various asset classes. I think everything will move back to the upside as rotation takes hold again. Moving on to chart of the day. For those of you who are interested in the chart of the day, you go over to earningsbeats.com, you scroll down. Here's where you can sign up for our free Earnings Beats Digest newsletter. We send this out 3 times a week, Monday, Wednesday, Friday mornings. All it takes to subscribe is a name and an email address. Hit that subscribe button. There's no credit card. You can unsubscribe at any time. I try to make these charts educational. Try to make them brief. It's not like you have to sit there and read for an hour. 2 paragraphs in a chart. Usually focusing on earnings, relative strength, price volume, candlesticks, maybe sentiment. Those types of things that are important to us. So make sure you check that out and sign up if you haven't already. Also, one of the great benefits there is we do a lot of educational events, free educational events. And when we do them, we reach out to our entire community, including our Earnings Beats Digest community. All right, so for today's chart of the day, I wanted to just show you the industrials. I mentioned this is a big part of the IWM, the Russell 2000. And when I look at this chart, I see support here. That's your gap support. And then I see a bunch of lows that kind of come in around maybe about that level. And so here, I mean, you can kind of see there's gap support a little bit below there, just a little bit below there. But you can see equal, we come right down to this level and top. There we come down into this range. Here's a bottom, there's a bottom, another bottom. Yesterday, we broke just into this range again. So when I see this, sometimes what I'll do, instead of showing two support levels like this, I get rid of that and I'll show a rectangular support area. I always use green for support. And then I just draw this kind of like this. So now it's just more of a zone. And I know some of my fellow technicians over at StockCharts, they like to use this as well. I know Arthur Hill uses these zones a lot. I think it's a good idea because sometimes you look back and you say, well, it's got to hold this low. Well, I mean, this is where we gapped up from. So I wouldn't want to go just slightly below these lows and still be saved by this gap support and treat that as a bearish development. I think as long as we hold on to gap support here, all these other lows, I think, kind of make sense. Everything kind of fits. And then clearly we have upper resistance right there. And I think it's pretty clear that you can see these tops. So we had the double top, had this low between. So that's what, about $4, 103 down to maybe 99. So when we break below, that gives us a measurement of $4 down to 95, which is where we went. And now we're just in this trading range. I know a lot of folks are saying, well, you know, this group, that group, not really keeping up. And it's true. They're consolidating, but they're not breaking down. I'm going to feel a little bit less bullish if we see the XLI break down or the XLF break down. But for now, I think we're still fine. In fact, I'm looking for a rotation or at least some additional support from this group as we move forward. All right, moving on. Let's take a look at gold and silver. There are a lot of folks out there that like gold. Don't count me in that group. I'm not a fan. Now, you look at this chart, you say, wow, since beginning of November, it's been uptrending. It looks really good, right? I mean, there's a big move there. Nice uptrend. Pull back, put in a higher low. Rise again. Now we got higher high. Pulling back. I mean, what's not to like? Looks like maybe we're at a trend line area support. So let's see what we have here in terms of a trend line. Pretty close. I mean, I could almost draw this thing to include that. I mean, and trend lines are pretty subjective. But I mean, if you do that, that's pretty darn close to saying, hey, we're holding on to this trend line. Now, the most recent high, right up here before we broke out, it's kind of holding, trying to hold. But I'll tell you what, watch this 20-day moving average right here. Can we get back up through it? The reason I say that is that you do have double top. Here was the bottom below. So that's what, 2060-ish down to 1980-ish. So that's 80, probably about $80. So if you drop that from 1980, it takes you down to 1900, which would be down here. Haven't gotten there yet. So we haven't made the measurement. And as we come back up, notice this was the prior low, that 1980 area. We finished yesterday at 1982, just below the falling 20-day moving average, which is below the 50, and the PPO is turned negative. So if we can get back up through the 20-day, and especially the 50-day, that would be a good short-term sign, better than the alternative. Because if we roll back over and go back down through the recent low, we'll clearly lose trendline support. We'll lose the recent price support. And all of this is coming with the moving averages turning bearish and the PPO going bearish. So I'm not really liking it in the short term, even though it is still in an uptrend. And I'll like it even less if we get another breakdown. Watch that 1940 area. The other thing I'm not a fan of, I've been talking about how on the major indices, how when we went sideways or even when we went down, the AD line kept going up, 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 showing Wall Street's accumulation. Look at the difference here. Back in November, beginning of November, when we first started making this move, we saw the AD line jump. So right here, the AD line was starting to show some pretty good stuff, right? Since then, gold has gone from 1775 above 1975. So we're more than 200 points higher, and the AD line's been drifting to the downside. So I'm not really liking what I'm seeing here on the chart. I mean, I think on the surface, you see an uptrend. I can understand why a lot of technicians would say, hey, gold looks good. But for me, I'm seeing a lot of cracks in the foundation. And more importantly, I'm going to show you on this 50-year weekly chart. Here's gold going up. It looks pretty good, right? Just keeps going up. Well, except for this period from 1980 to 2000, where it went down for 20 years. But look at the relative strength. And notice when we see relative strength, we see it in the 70s. We saw it at the end of 1987, market crash. We saw it during the Persian Gulf War, relative strength. We saw it during the financial crisis. We saw it during the aftermath when we had some echoes of the financial crisis. And then that's been just about it. A little blip here for the pandemic. A lot of folks say gold is tied to inflation and to the dollar. When I look at it, I think its strength comes from higher volatility. When things get fearful, that's when gold outperforms. People, when they start to panic, will go into gold. And if I'm looking at this, a lot of folks are looking and saying, look at this triple top here. This is going to be great for gold. It may go higher. My concern is, though, that the S&P 500 is going to go a lot higher. So gold, even if it goes higher, may continue this downward spiral on a relative basis. So for me, not interested. Silver looks very similar to gold on the absolute chart. Moving up, pullback here was a little steeper, I'd say. But the rally was nice. Double top, failed on the breakdown here. And this rally hasn't really been as strong on silver. Hasn't gotten back up to the breakdown level. Hasn't gotten back up to test the 20-day moving average. So here we got a little bit bigger problem. And just like gold, AD line really not showing much, at least not on the bullish side. All right, let's move on. So we've got some earnings to talk about. And I'm just going to run through and show you the reactions because they are all over the place this morning. But let's go through a bunch of these here real quick. Salesforce.com, not showing. That was down yesterday. I'm not sure why it's not showing anything this morning. CRWD, not showing. All right, I'm going to have to just go to a different area and take a look at what's going on here. So bear with me. CRM. So Salesforce down. I don't have it up on your screen. I got it on another computer. I'm sorry. Down 6.7%. It's down $15, $208. CrowdStrike down $17, down 11% from 160 to one. That's now down to 143 this morning. And I'll just pull these up just in case we get a price on it. Nope. VEEV. Up $14, up almost 9% to $180. Network Appliance, NTAP. See the close yesterday, 66.35. And this morning, well, I am showing this one unchanged on a different site, but we'll have to wait and see where Network Appliance opens. Then next, we've got Okta, another software company. So we closed there at 90.90. And let's see, I'm showing down $16.60. 74.30. That's down 18% this morning. 74, we're talking about way down here is where it's going to open. Not looking good there. Chewy, big report here. Closed yesterday 29.49. This morning, up 571 to 35.20, up 19%. So, I mean, there are some huge moves going in both directions this morning. AI, had a lot of talk about AI. Closed yesterday, $40.01. Today, after earnings, down $7.55 to $32.45, down 19%. I don't think I've seen a day where so many of these stocks are either gapping up huge or gapping down huge. Dollar General reported this morning. And you can see Dollar General has been struggling to hold on to support. Well, they reported, and they are down $21 to $180. That's down 10.5%. Bad, well, not even bad. I would just say mixed. Some big ones to the upside, probably a little bit more big reactions to the downside. These stocks that I've shown you so far are going to be extremely volatile today. Wouldn't be surprised to see a bunch of them bounce in the opposite direction of the direction they open, but we'll see about that. All right, last thing, 3 you must see. I'm going to first show you 3M. And so 3M thought maybe it was going to try to bounce, but we only could get up to the 50-day moving average. That was it. Back down again. You can see that AD line just continues to drift. Relative strength is horrible. Just nothing to really like here as it continues to push lower and lower and lower. Next up, Travelers. Travelers, big move down here over the last 7 days, just below this gap support level. I didn't like to see that on increasing volume. AD lines rolled over, relative strength rolling over. Watch these support levels right in here from about 168 down to 162. And the last one I have is Home Depot. AD line rolling over, price action not really following the market to the upside. So the underperformance is real. Big support though right here. There's gap support from about 280. A couple of these lows just a tad below 280. If we lose that support area definitively, we're looking back at 260 to test these other lows to go back further. All right, that's it for me. I appreciate everyone tuning in. Have a great day. Let's see what happens with the debt deal and with all that's going to happen here in the month of June. Happy trading, everybody.